A warm welcome to the third day. I know it's tiring. We'll try and see how can we make it interesting. We got our young actuaries, three of us here, and with a very interesting topic. We got Jyotsna, we got Mohit and Ravi, and I think the way we will split that is actually they're going to have some presentation, a very short presentation, and then followed by questions. But I think the topic is, if you look at, we traditionally, the actuaries of my cohorts, were more and more looking at the liability side of the balance sheet. We were most of our valuation actuaries, and we're looking at more from, future cash flows, deriving the valuation basis, but assets were being looked after by the CI, Chief Investment Officers, and the investment team. But with all these, uncertainties that we're seeing, your interest rate changing more frequently in either direction, the inflation is changing, your overall claim spikes, and a lot of other uncertainties we've observed over a period, is really expectation is that actuaries also need to start looking at the interest rate side, the investment side, and some of these three young actuaries actually will bring in those perspectives as to, how do you really look at from the investment perspective as well. And I think it's high time that actuaries also get involved on the investment side. And those traditional way of looking at just on the asset side is perhaps no more applicable. There's much more responsibility that we have as an actuary to the society and to the companies in terms of also looking at the investment side and see how could we really align the both sides of the balance sheet and a stable balance sheet and a more resilient balance sheet to all these uncertainties that we face. So I think we can start with the presentation with Jyotsna.
Hello, good morning all. First of all, well done for turning up for first presentation on the last day of the conference. Hi, I'm Jyotsna Kaushik, and we are going to take turns to speak on the insurance innovation, and I'm going to speak about the insurance innovation in the space of life insurance. So, just to set the scene, I mean, what are the major risks in life insurance? So there are, of course, a number of risks in life insurance, starting with the market and ALM, which include the very, very basic vanilla interest rate, inflation, and currency risk that a portfolio may have by virtue of the exposure to these risks in their liability. And I think one thing I want to start with is that a lot of this is in the context of annuities, which are a life insurance product. They have a long tail, and that is one of the key features of the life insurance liabilities, that they have much longer tail and much longer term in comparison to some of the other businesses, which means that you also need assets which are a good match to those long tail liabilities. Next is the mortality and longevity risk. And before I move on to the next slide, I will probably come to this one a bit later. But mortality and longevity risk, of course, it is something that we as actuaries are very, very interested in. We understand it is the risk of our policy holders living longer or shorter than expected. And that is going to have an impact on the duration and the shape of the risk on the books. Then the data risk, more and more important with the amount of data that we are generating, amount of data we are consuming, and then also how are we using that to price our risk, and if there is any mispricing as a result of how we are collecting and how we are consuming that data. Climate and sustainability, again, becoming increasingly important. Also, not just because of how we are impacted by it, and also how we are reporting it and how we are managing it. And then moving on, the liquidity and credit risk, which is something that your portfolio may face as a result of the assets that you have on your books in order to manage your liability. And then finally, moving on to very, very important, regulatory conduct and policy change. So this is the regulator may have capital framework and regulatory framework in order to see that how insurers are managing their risk. So for example, upcoming RBC framework in India and existing Solvency II framework in UK, under which you have to report and manage your risk. And then finally, model risk. Models are something that we actuaries are very, very fond of using. One thing I want to add is that models are only as good as the people who are making it, as good as people who are validating them, and as good as people who are using them. So I think which is where it increases an individual risk, it increases a personal risk there, and it has to be managed very, very well. And as I was saying before I move on to the next slide, which is the innovation investment mandate and operations, I want to add that why is it an important risk and why is mortality not such an important risk, and we are not touching on it. In the perspective of annuities, and especially in some of the mature markets, longevity risk or mortality risk is something that the insurer reinsure away. So they go into contracts like longevity swaps, which can take away the longevity risk on their portfolio, and which is why the investment risk becomes very, very key. Sorry about that. So how do you manage investment risk on a portfolio? So you can have a principle-based approach. How you do it is that you do a liability-driven portfolio management. So you look at your risk in the perspective of how your liabilities are. So you design your portfolio on the basis of your liability. You look at your liability, what their duration is, what their exposure is, and then you design your portfolio on the basis of that. Again, the next point, the drivers of your investment mandate is that your assets match your liabilities in duration, inflation linkage, and currency. And then if any residual risk that your portfolio has by virtue of the assets that you have, for example, if you have inflation, currency, or interest rate, then you invest into swaps in order to manage that. So you go into derivatives like forwards and swaps that can manage those assets. Now, what those assets do to you is that you go into your assets that improve the yield and then also diversify your portfolio. And but then what you do in order to do that, you try to find new assets which provide higher returns. So, for example, you try to invest in private assets, which could be in the form of CLOs, ABS, your CREL, which are commercial real estate leases, securitization, and infrastructure assets. But then when you go into these complex and niche assets, which are private assets, it also introduces new and complex and niche risk to your balance sheet. For example, some of the risks that these complex assets bring to you, they are credit risk, prepayment risk, liquidity risk, like when you have to raise liquidity very, very quickly, can you convert your assets into liquid assets very quickly? The economic environment under which you are operating, so if the regulatory regime allows those assets or not, then when you want to value those assets, how much probability can you value them that when you are going to go in the market to sell those assets, you are going to get that value. So that valuation certainty, that is very, very important to assess. And then the collateral risk. So if you have any asset and if you have to sell it quickly, whether you have covenants in place in order to generate money quickly. And then how good is the service and the quality of that collateral? That is also very important. And with the use of these private assets, you also need to have capability in order to assess the risk that they present. So you need to have internal credit rating capability in order to manage that risk. That is very important. Next thing is that whether your investment, because with the climate risk becoming very, very important, how you manage, how you assess, and then how you present that risk is very important. So whether your portfolio is also aligned to sustainability, mandate of of the company. I think that is very important. And then how do you assess that the sustainability mandate is met? I think that is also very important. Regulators have requirement for disclosures, which ask company to present certain MI on a regular basis in order to assess that. But how you are doing is also very important. Then finally, when you have got complex models, then you need to have appropriate governance in place in order to manage those models. And then finally, you need to have consistency across solvency, accounting, and your daily pricing, and then align liquidity term. So not just the reporting, it is also how you integrate all of these components into your daily operations, and then how are you fair to the customer is also very important. So basically what we are trying to say here is that the theme is that you look at your liabilities, you invest into assets which are aligned to those liabilities, and then you look at what are the risks that this mandate has created, and then you try to manage it, and then all of this needs to be aligned to the reporting and the regulatory requirements. Also at the same time, managing the risk that the data and modeling is presenting to you. Moving to my final slide, which is talking about how do you use technology and how do you integrate technology to every step of your investment mandate, and then that will help you create a risk resilient structure. So I'm talking about 5 pillars here. The first is data quality. Data is, as I said, very, very important. I recently heard something which was in a TV show, but I think it is very, very relevant to us as well. The line went something like, "Pehle Bhagwan deta tha, ab Bhagwan data hai," which I thought is very, very true for us also. But what we are trying to do here, and what I'm trying to say here, is that you cut your problem into 5 parts, and then you look at each of that component separately, and this is how you can integrate technology. So first is that you integrate technology into data quality, integration and lineage. So if you have any unstructured data, then you convert that into structured and queryable and traceable data sets. And then you need to create automated APIs in order to take that data into your models. And that includes both your assets and liabilities and market data. And you create appropriate data lakes to store those large amounts of data. And then you integrate that into end-to-end daily reporting. Next is that when you create your model design, you need to allow for regulatory and also your other metrics, which includes your capital framework, as well as your sustainability metrics and all other important metrics as part of the design itself, rather than thinking of them as an afterthought. So all of these should be part of your design inputs and not just something that you're going as you go along. Next is that the technology that you use and that technology that you build, it needs to be scalable, it needs to be agile so that it can absorb any changes, and it should be auditable. You need to have daily analytics which can be assessed, and they can be interpreted by the management. And next, where you integrate AI into your systems and technology, it needs to be under proper governance. So if you're using AI, whether for interpretation, whether for summary, or whether you're using agentic AI to generate solutions, all of this needs to be done in a regulated environment, in a validated framework. And lastly, you need to bring everything together under reporting. So you need to bring governance, risk, visibility, and accountability. So these are very important pillars under reporting. And when you are integrating technology, then you need to ensure that these are all accounted for appropriately. Sorry, that was a very, very quick whistle-stop tour because we have got 2 more speakers. Next, I would like to invite Mohit to speak about general insurance.
Yeah, thank you, Jyotsna. And I would also like to thank Hemant, who was my co-author in preparing this slides and the abstract as well for this presentation. So, I would like to focus on the key risks that are faced by the GI companies today in India. And I am specifically focusing on the motor line of business as well as the health line of business, considering the fact that those particular LOBs, have the most amount of IBNR, as well as it contains the most amount of premiums with respect to the general insurance companies in India. So if you just look at the key risks that are faced by the GI companies right now, we would see that there are a lot of court judgments which have historically affected the TP claims. Additionally, there is minimal rate change in the latest few underwriting periods with respect to TP claims. And there's been constant inflation risk with respect to medical inflation or motor inflation or repair inflation or social inflation as well. And additionally, there's also a very important factor that I would like to place is the fact that there's a huge tail risk with respect to TP claims, considering the fact that it usually takes 20 to 25 years for the claims to get settled with respect to those TP claims. And there are a lot of mid-sized companies and small-sized companies who have just started writing business or have operated business maybe from 2013, 2015, and they still don't have enough data to capture the entire period so that like the oldest accident periods are still not in runoff for those companies. And additionally, the fact that there is a school of thought that's going on that the frequency reduction that was there in the prior periods or in the prior accident periods might not be there in the recent few periods, and the fact that frequency might be flattening across the recent few periods as compared to what the frequency was in the prior periods. With respect to this, we collected a lot of information which was available using public sources such as NL38, NL4, as well as Federation of Automobiles data, and additionally the MORT report as well. So if we just look at the fact of the tail risk for TP companies, so for AY 14-15, we were able to observe using the NL38 data, like most of the companies' ultimates had increased from their original estimate to their estimate as at 24-25. And for 2015-16 as well, it was a mixed batch where some of the companies had to increase their ultimates because of the fact that they had underestimated their tail risk. And additionally, the fact that from 2014-15 to 2019-20, we were able to see like a close to 6 to 7% increase in their ultimates for public companies all across India, which does signify the fact that tail is considered to be a very highly important factor for TP. And additionally, the fact that there has been some underestimation, or there might be a lot of cause that there because of external judgments, court judgments, and other situations and scenarios, that the fact that there have been increases in ultimates as well. And with respect to the frequency flattening, what we did was we collected data from FADA, which is the Federation of Automobiles data, to calculate the notional exposure across every year. So if we just look at the total registered vehicles across India, so it's increasing by close to 4 to 5% for every year. The only exception being the year 2020, because it was a COVID year where the increase in the registration of vehicles was close to 10% in 2020, might be because of the fact that there were a lot of people who were afraid to travel through public transport, and that is why they had purchased their own vehicles. But across the rest of the years, we were able to see that the total number of registrations were increasing by close to 4 to 5%. And with respect to the MORT report as well, what we were able to see that from 22 to 23, there was also close to 4 to 5% increase in the total number of people who were killed and who were injured with respect to the TP claims. So basically, the exposure as well as the total ultimate claim counts are getting offsetted by each other, which does raise a fact that in the recent periods, frequency might be flattening as well. Although, like, we would be able to get a picture of it once the data is more credible and once the data gets arrived. Also the fact that for year 24 and 25, I have just extrapolated the numbers from 22 to 23. to just show the fact that there might be a cause of reason that the frequency is now flattening, although the frequency might reduce due to sourcing or business mix changes, but additionally the frequency that was there might not hold true in the recent periods. So we also calculated the loss ratios of the top 7 general insurance companies in India for AY 23-24 as compared to AY 24-25. So if you look at the right-hand side of the loss ratio line graph, we were able to see that there's been a close to 6-7% increase at a weighted average level. That is, the loss ratio has increased from 90 to 96% across AY 23-24 to 24-25 for these companies. And additionally, the fact that because of the fact that there is a lot of severity inflation as well as frequency inflation in the health book as well. So we calculated this data from the IDA handbook, where we were able to notice that the loss ratios for all the standalone health insurance companies are basically increasing across different reporting periods, where we were able to take a proxy of reporting periods being accident periods, considering that health is a short-tail line of business. And here also, it is the same trajectory that we are looking, that the loss ratios are increasing year on year with respect to the frequency and the severity inflation, which is only partially offset by the increase in premiums. So I would also like to give a correlation structure between risk resilience as well as investment. So if the investment structures are basically sound, then there would be stable income opportunities with respect to GI companies, and it would also help to offset any underwriting volatility that the GI companies would face. Additionally, there would be basically no liquidity errors or no issues with respect to solvency ratios as well, if the investment principles are sound, basically. And the additional fact that investment principles become much more important in case of maybe cat events, large events, or excess inflation, or even if there are reinsurance delays or settlement delays with respect to reinsurers when there are cat claims. We can also look at like industries across our neighbors, just for example, like Sri Lanka, where we were able to observe like in periods prior to 22, 23, 23, 24, there was a lot of economic volatility and there was a lot of excess inflation with respect to that. And additionally, in the recent year as well, there were a lot of flood claims as well with respect to the cyclone event that happened in Sri Lanka, causing the solvency ratio to dip for some of the companies with respect to GI companies. Some food for thought would be like what should be the new focus areas with respect to investments for GI companies. So should we look at like, is there any correlation between cat risks and market risks? Is the fact that if there is any cat risk, my investments are also going down? If there is any fact like, how is the inflation with respect to the liabilities, where we are seeing that there's a close to 10 to 12 or 13, 14% inflation with respect to medical inflation and motor inflation. So are the assets also giving me the same yield and the same return? And also the need for cash flow adequacy testing and stress testing and scenario testing. If those cat events occur, what would be my liquidity position? What would be my solvency position as a company? Am I still reliable? Am I still resilient? So these are some of the areas that we should look going forward. So some of the techniques for risk resilience that could be built. So firstly, I would just like to focus on the tail risk part. So there are basically, because of the fact that a lot of companies who are mid-sized companies and have just started writing operations, so they can just use NL38 to calculate the implied incurred percentage develops, which would give them at least a benchmark comparison on what should be the tail, what should be the number of years to run off with respect to the TP claims. Additionally, just doing a quick analysis of AV as well as AOC, where the change in ultimate can be explained through different methods. Is it due to the change in ILR or due to the change in methodology, or maybe any residual change that is coming out to be there, or if there's any premium experience change that is coming out to be there. Additionally, they can use their settled triangles, which is basically a derivation of closed counts by reported counts, in order to just understand the number of years to run off with respect to the tail that they'd like to implement with respect to the TP claims. Just for example, like if the oldest accident periods are 90% developed, and for the recent calendar periods, it's just taking, the settlements are increasing by 1% every calendar period. So that would at least give them an indication that it would at least take 8 to 10 years more for the earliest accident period to be in runoff, and that is how the chain ladder methodology should be developed. Additionally, there may be a cash flow adequacy approach that the companies might also follow, just to check what are the claim reserves that they are setting for the earlier accident periods. Just for example, like they can just take the incremental settled severities across the recent calendar periods and multiply that with the claim counts that they would think that they would settle in the future periods, and take the inflation structure as well to get the notional or the expected claim reserves and compare it to the actual claim reserves that they are holding. So these are some of the structures or some of the areas that companies can see and make adjustments in order to just be mindful of the fact that they're not underestimating any of the risks. Additionally, the fact that they can use also a risk adjustment technique and a definition of a best estimate to be a true best estimate, and using different techniques like bootstrapping approach to calculate the tail risk and to allow for parameter uncertainty as well as process uncertainty to so that the risks are basically not underestimated.
Mohit.
And quickly, just there are some other techniques such as portfolio analysis or clustering analysis, or making claim handling or settlement techniques, or making fraud models, which the companies can basically do so that their risk resilience could be better.
Thank you, Mohit and Jyotsna, for setting up the tone. So they have shared their thoughts about life and GI. So now I'm going to talk about the pensions. So first, my presentation argues that the pension system must move beyond the optimization framework built on historical averages and determined projections. Let me start with the simple propositions. Today, pension valuation is increasingly driven by the three critical pillars. First, the interest rate and the inflation. Second, the longevity and demographic. And third, the capital market and regulatory dynamics. These are not cyclic fluctuations. We are witnessing a structural break in how pension system is measured and managed. For nearly 3 decades, actuarial models were built on the assumption of low inflation, falling interest rates, and the stable longevity improvements. So I'll briefly frame these three structural fractures reshaping the pension risk today. So first, let me talk about the inflation and the interest rates. We have witnessed that the inflation peaking nearly 8 to 10% globally after that COVID period, basically in 2022 or 2023, I would say, like inflation was peaking around 8 to 10% globally, and 400 to 500 basis points rate hike within a month. Historic bond rate volatility. For pension fund, this means the massive liability revaluations, collateral waterfall under the LDIs, funding ratio moving not gradually but violently. Traditionally deterministic model built on the mean reversions and smooth yield curves were not calibrating for the regime discontinuities. Second, longevity and the demographic. We have observed slowing improvements in the sum population, socio-economic mortality divergence, pandemic, and the climate-linked health overlays. If I talk about climate and the geopolitical fragmentations, climate transitions are no longer theoretical. We face physical risks like flood, heat stress, assets impairment, transition risks like carbon pricing, standard assets, geopolitical realignment like supply chain bifurcation, sanctions, energy shocks, etc. So these are not independent variable, basically. So they interact. If I say inflation plus energy shocks plus liquidity stress is no longer a tail risk, it is an observable history. So fundamental question becomes, if assumptions are structurally unstable, can we still rely on the optimization framework built on the stable averages? So answer to this should be no. So we must shift from a optimization to the resilience. So let me introduce what we call its resilience-oriented actuarial cycle, which is ROAC. So it extends the traditional actuarial control cycle, not by replacing it, but by embedding a structural uncertainty at its core. ROC operates in the four continuous phases. So phase one is basically a comprehensive risk identification. So not on the silo based, but interconnected risk mapping across financial risk, including liquidity, correlation breakdown, or demographic risk, climate risk, geopolitical and macro fragmentations, or operational and the cyber risk. Liquidity risk in particular has emerged as a structural, not incidental. If I talk about the second phase, which is advanced modeling or stochastic modeling, we propose like stochastic ALM with full distribution modeling, regime switching, economic scenario generator, climate adjusted macro financial pathways, liquidity stress simulation. These all should be taken care. Instead of asking what is the expected funding ratio, we should ask what is the 5th percentile funding path under the regime persistence. I think we should move from a point estimation to the probability distribution part. And if I go to the third phase, that is a resilient strategy. So it's a strategy must be dynamic, element-driven, liquidity aware, hedge-adjusted, risk transfers integrated. And the most important phase is the continuous monitoring. Actually, resilience is not episodic. It requires early warning indicator, funding triggers, liquidity coverage matrix, climate exposure, cyber governance dashboards, etc. So monitoring feeds back into a modeling. Modeling reshapes strategies, and strategies reframes the risk identification. It is a continuous adaptive loop, basically. So ROC is not a model, it's an institutional mindset shift. So if we move from an optimization to the resilience, what kind of implication it may have on the investment and the governance side? So next slide we'll talk about that. So if I look at from the investment side, first thing is basically instead of looking at the, if I talk about the investment side, the first thing is downside probability focus. Downside probability focus is instead of looking at the expected returns, pension fund should focus more on projecting against losses. Key risk measures like surplus at risk and the tail risk metrics are becoming the more important factors. Next is dynamic hedge ratios. Having a fixed 100% hedge can create a liquidity stress during a market shocks. Third, liquidity buffers. Being solvent is not enough if liquidity is tight. Pension fund should plan for liquidity needs. Liquidity planning should be considered strategic priority, not just an operational task. The fourth, tail risk basically. So its portfolio should be structured to withstand and the even benefit from the market stress. This can include convex overlay, long volatility allocations, trend following components. So these components can help portfolio perform better during the market disturbance. And the most important governance implication, we recommend basically formal risk appetite framework tied to the quantitative threshold and pre-agreed trigger to avoid behavior delays, dedicated liquidity oversight committees, and cyber resilience embedded at board level. So, if I conclude it, so pension funds operate across decades, but they are increasingly tested in days. Resilience is not predicting the future. It is about preparing for a multiple futures. A resilient pension fund is one that can absorb shocks, recover quickly, adapt continuously. The shift from optimization to resilience is not theoretical. It is essential for a safeguard retirement income in structurally uncertain world. Thank you.
Thank you, Ravi. So we have, maybe I'll just ask a few questions and then we can open it to audience if we've got some time left. I mean, we heard a lot on the investments, and I've been actually a great advocate for actuaries getting into investments. Some of you would know. I try and push how do we actually have actuaries working in the wider areas, and we have a few examples now. So really glad to see some of them. I think it's, you know, with the investment risk resilience, the actuaries have a significant role to play. What would be the role that, you know, actuaries can play much more on this mandate? Maybe we can start with you and then the rest of the
Thank you.
speakers.
Thanks, Sunil. So I think there are a few ways in which actuaries can contribute to investment, and I think it is still a slightly non-traditional area for actuaries. Is that you do not see many actuaries working in the investment landscape, not just here, outside also. They are very, very far and few. And I think the ways in which they can contribute is that working in insurance, I mean, actuaries are someone who understand insurance risk more than anyone. And then of course, I mean, a lot of our work is centered on liabilities, but then assets is and market risk, I mean, they are just different risks. So what they are very good at is assessing that risk and how do you build that and how do you manage that risk in order to, and how do you allow that into the future framework. So I think that is where they can really contribute. Other way in which they can contribute is in setting the strategy, like the ALM strategy. They can, and ALM is an area which marries assets and liabilities, and actually is being very, very good at liabilities. They can contribute very nicely to this. They can help setting investment mandates in the company. They are very good with numbers. They can do scenario analysis. They can check that how do your assets and liabilities behave under different sensitivities and use that to decide hedging. They can use that to integrate into the capital framework. A lot of work in the UK under the capital framework, which is Solvency II, it is centered around how companies are managing their assets and liabilities. So that is an area in which a lot of actuaries work in the UK. And with the risk-based capital framework coming to India very, very soon, I hope that it will be same in India also. And I want to add that within the life insurance space, and I said that earlier also, annuities are one of the business which have a long tail, and that is where you need to have assets which are a good match to your liability, considering the longer duration, and then also the risk exposure that it brings to your balance sheet. Apart from that, I think actuaries can also contribute to the, you know, the policy setting of the company itself. So it is, they can, and because actuaries work in different areas of the company, I think if they work together, it also helps in, you know, having a consistent framework across the company. So you do not think of investment as just one function. It is something that has to be integrated and that has to be collaborated with other functions like pricing, valuation, everywhere. So because actuaries work in each of these spaces, they can collaborate and they can work in a framework which is then consistent across the company. So I think that is where actuaries can.
Thank you.
With respect to investments, I think in the GI industry, I think general insurance people, like, they are more on the liability, they focus more on the liability side. But there, as I just mentioned, that some of the reasons where we can look at the investment sides would be the fact that considering now that, just for example, like inflation is increasing at a rate of 10 to 14% per annum, it might be good for the GI actuaries to look at the investment side as well, whether their returns are also accumulating at this return or not. And also just to maintain the ALM structure as well, whether the fact that if the asset liability management is being taken care with respect to duration as well, along with the fact that just identifying different structures, maybe like there might be a lot of correlation between cat risk and market risk. Just for example, like if there is any terror attack, or just for like, it might have happened in the 2611 where the equities also crashed. So if there are certain situations with respect to that, then maybe industries as well as actuaries can also look into those structures and like mandate their investments and structures accordingly. also the fact that there has been some scrutiny around investment structures as well, where we are seeing that like companies are trying to move to the green structure, and there should be less carbon emissions, etc. So over there as well, I think there are a lot of scope with respect to actuaries moving through the innovation structure as well as the investment structure. Also trying to maintain the risk resilience also.
Thank you, Ravi. I think it's interesting on the pension side, and I would like to remind that a large number of actuaries, particularly consultants, works on the retirement benefit side, valuations, how much contributions, and also, you know, surplus deficit, etc. And I don't really think that we look too much on the investment side or the asset side. We just give on risk-free rates or whatever. But what would you expect the actuaries to really going forward on the retirement benefit side?
I think actuaries are already playing a vital role here. So if I say actuaries are sitting at the center of, basically at the intersection of liability, assets, risk, and governance, basically. So as an actuary, we transfer, basically, we translate the risk, like, not the risk, I would say, like, we translate the impacts of change in assumptions, be it inflation risk or be it a climate change or something, into a quantifiable balance sheet impact, basically. And we also strengthen the governance also, and we shape up the risk appetite and capital building also. So in my opinion, actuaries are not just to do a technical calculation, technical world. We are here, we should be working with the institutions to innovate in responsibility, so that such that long-term sustainability should be achieved in this uncertain world.
Sure, thank you. No, I think just to conclude this discussion, I would say, I mean, we just used to, in past, working on the immunization. I mean, you all have gone through the immunization theory, matching the assets and liabilities, and it was more of a passive approach. And in this VUCA world, when you have so much of uncertainties around all variables, and the whole investment side is becoming much more complex. You know, you got all private assets, you got AIFs and all, you know, many of derivatives and all that that's now coming in really. I think the ALM becomes much more dynamic than what it used to be, more of a passive approach. You just look at the duration of assets and liabilities at the end of the year, or maybe just look at the sensitivities of assets and liabilities, and if they're moving in the same direction. There are events that are happening which may increase the liabilities and also reduce the assets. And I think those immunization theory doesn't work there, and therefore it is important for us to look at the ALM much more dynamically than we used to, by linking our systems of assets and the liabilities, you know, I think dynamically. I think its time is up, but any one question we can have from the audience? Yes. Mike, please.
Yeah, it's quite insightful session, so thank you so much. So my question is very pointed. This is regarding cat bond. So globally, we have seen cat bond has actually, you know, given a kind of a shield to insurance companies. But in India, you know, we haven't seen much about cat bond. So any thought about these kind of bonds, because now climate risk is increasing. So just want to hear from you how big, you know, this market would be as far as cat bonds are concerned.
I think, no, a very interesting question. And I think, you know, cat bond requires a lot of infra investors interested in terms of investing in that. And it's much more prominent, particularly in the US markets, where a lot of catastrophe. Every year, actually, there's a season for this. And you know, all the reinsurers who actually write these cat is really just pray that, you know, the catastrophe is within their bounds. I don't think we actually are in a stage where we really need the cat bonds, because we've been very, very lucky not to have catastrophic, the geography we live in is not so much of catastrophic. Perhaps maybe as the liabilities and the, the side become much larger, maybe there could be a place for the catastrophic bonds. I think the insurance companies